Shanghai port, once the heartbeat of global trade, now looks like a graveyard. Shipping containers are stacked like forgotten tombstones. Silent, unmoving, unwanted. No engine hum, no cranes swinging, just wind and dust. In Ningbo, a security camera captured a truck driver sitting motionless in his cab for over 4 hours. No cargo, no assignment, no future. US-bound shipments from China have collapsed by 64% year-over-year. Trans-Pacific routes are nearly paralyzed. But the question isn't just about logistics, it's about survival. What happens when the factory of the world loses its biggest customer? And what if there's no replacement? Behind the numbers, behind the ports, lies a deeper story. One that Beijing won't tell, and state TV won't show. This isn't just a slowdown, it's an unraveling. And it's only just begun. It started with silence. In April 2025, shipping data from Vision and Linerlytica showed a staggering 64% year-over-year drop in Chinese exports to the United States. Trans-Pacific freight volumes collapsed by over 50%. The world's 5 largest container lines began downsizing vessels, moving from 18,000 TEU mega ships to smaller 14,500 TEU models. By May, at least 24 China U.S. sailings were canceled. The west coast of America saw its port activity drop by over 30% in a single week. But the numbers only scratched the surface. At Shanghai port, one of the world's busiest, thousands of containers now sit abandoned. No destination, no pickup. In Ningbo, aerial footage reveals entire blocks of dock space turned into impromptu storage zones. Workers describe it as ghost port syndrome. They still show up, but the work is gone. Why? One reason: tariffs. In early 2025, the United States imposed a sweeping 145% tariff on a wide range of Chinese imports, everything from electronics to plastics. The move not only slammed existing exporters but also shut down the low-value loophole known as de minimis, a policy that had previously allowed goods under $800 to enter the U.S. duty-free. That's how companies like Temu and Shine thrived, by shipping millions of cheap packages directly to American households. But when the loophole closed, so did their margins. Every $50 package now incurs a $31 documentation fee, a $20 brokerage fee, and a potential 35% import duty. The result? Costs nearly double. For many sellers, that means bankruptcy, and they're not alone. According to the China Cross-Border E-Commerce Association, nearly 500,000 merchants relied on platforms like Temu and AliExpress. Their collective ecosystem supported over 2 million jobs in warehousing, packaging, logistics, marketing. With the U.S. door now bolted shut, at least 600,000 workers face direct unemployment, with millions more at risk from the ripple effects. But this isn't just an e-commerce crash. The damage runs deeper. China's April manufacturing PMI fell to 49.0, its lowest level in 16 months, signaling contraction across the industrial sector. Private surveys from Caixin and S&P show a rapid deceleration in both new orders and export demand. Factories are shutting down, not because they lack production capacity, but because they lack buyers. And those buyers aren't coming back. America was China's lifeline. In 2024 alone, U.S. imports accounted for $389 billion, nearly 1/3 of China's total exports. Now, that artery is severed. Beijing calls it a temporary adjustment. But for workers watching ships idle at the pier, for merchants drowning in inventory, and for port managers laying off staff, this isn't temporary. This is structural and irreversible. The world's second-largest economy has hit a wall, and on that wall are thousands of rusting containers, each one a symbol of a deal that never happened. This wasn't a surprise. It was a time bomb built into China's export model and now detonated by U.S. policy. For years, China's economy leaned on 2 crutches: real estate and exports. With property sales collapsing since 2021, exports became Beijing's last reliable engine. But it was always a fragile dependency, built not on innovation or diversified markets, but on low-cost labor, razor-thin margins, and favorable trade loopholes. The de minimis exemption was one of those loopholes. It allowed millions of under-$800 packages to flood into America, skipping duties and customs checks. In 2023, over 60% of all duty-free small parcels into the U.S. came from just two Chinese platforms, Temu and Shein. Combined, they were responsible for over 10% of China's total exports to the U.S. That loophole is now gone. So Beijing pivoted, at least on paper. Chinese companies raced to set up warehouses inside the U.S., hoping to survive through localized fulfillment. But that solution was a mirage. According to Citibank, Temu's U.S. warehousing effort covers less than 10% of its business volume. And the cost is brutal. Local warehousing eats up 8 to 12% of product value, plus another 5 to 8% in domestic logistics. Add tariffs on top, and margins vanish. Example: a small seller generating $1 million a year with a 15% margin would normally net $150,000. But with a 10% tariff and additional handling costs, their profits drop to around $50,000, barely enough to survive. Many are now underwater. Worse, U.S. regulators are closing the other escape routes too. New legislation in Congress would require foreign e-commerce sellers to register U.S. entities, disclose their supply chains, and post bonds, turning casual exporters into full-on corporations with legal liability and tax exposure. China's fallback plan, rerouting exports through Vietnam, Cambodia, or Mexico, is also collapsing. In early 2025, U.S. Customs began tracking certificate of origin documents more aggressively. Round-tripping, where Chinese goods are minimally altered in a third country to avoid tariffs, is now under scrutiny. And the U.S. Department of Commerce isn't playing games. One Chinese factory in Cambodia now faces a 3,521% retaliatory tariff. That's not a typo. It's a warning. Beijing's Plan B has failed. There is no detour left. Not through Southeast Asia. Not through bonded warehouses. Not through local proxies. The global supply chain isn't just reshuffling. It's rejecting China altogether. And the evidence is piling up in concrete terms. Apple is fast-tracking iPhone production out of Shenzhen and into India. American retailers are shifting procurement contracts to Vietnam and Mexico. Even Chinese companies are asking Indian exporters to fulfill U.S. orders on their behalf, offering commissions just to stay in the game. But it's not working. The machinery of Chinese trade isn't just stalling. It's being dismantled, piece by piece. At the center of this slow-motion collapse are the ports. The same cranes that once lifted the Chinese economy are now frozen. The steel arms hang lifeless. And for every idle container, there's a business that won't reopen tomorrow. In Yiwu, Zhejiang Province, a city once known as the beating heart of China's small commodity exports, dozens of factory gates are locked. Not temporarily, not for Spring Festival, but permanently. One by one, the handwritten signs started appearing. Factory closed until further notice. Production suspended due to market conditions. For rent, these aren't isolated cases. They're symptoms of a broader collapse. Throughout the first half of 2025, over 42,000 small and medium-sized export businesses across China either suspended operations or declared bankruptcy. According to Caixin's Q2 financial survey, 40% of surviving exporters are operating below break-even levels. That means they're working just to avoid defaulting on bank loans, not to make profit. Their clients are gone. Their margins have evaporated, and their cash flow is bleeding. The reason is painfully simple. They were built for one customer, the United States. From home goods in Dongguan to phone accessories in Shenzhen, these factories didn't just sell to the U.S. They were engineered around the U.S. system, product standards, shipping times, Amazon fulfillment, made for America certifications. They invested in molds, machines, and packaging tailored for one market. Now that market is locked. One business owner in Guangdong, Mr. Lin, ran a mid-sized plastic mold factory with 220 employees. His core client, a U.S. home appliance brand, canceled orders in March. By May, his warehouse was full of unsold stock. The bank froze his line of credit. In June, he shut down. No severance, No exit plan. They told us tariffs might come, he said. But we didn't know it would be like this. He's not alone. In the Pearl River Delta, the ripple effects are brutal. Thousands of logistics firms, freight forwarders, and export agents who once lived off commission-based shipping have seen their volume drop by over 70%, according to the Guangdong Logistics Association. Some have pivoted to domestic e-commerce or moved into gray markets to survive, but many are just walking away. Even giants are bleeding. Shine, once the poster child of Chinese e-commerce rise, is quietly laying off warehouse staff in Nanjing. Temu, which spent over $1.5 billion on U.S. ads in 2023 alone, has slashed its 2025 media budget by 60%. Internal memos show that its Global Expansion Task Force has been dissolved. The Canton Fair, China's flagship trade expo in Guangzhou, paints an even grimmer picture. Normally packed with foreign buyers and deals worth billions, the April 2025 edition saw foot traffic fall by over 45% compared to last year. Booths went unmanned. Translators and hosts were dismissed halfway through the event. One supplier said bluntly, "It felt like a funeral. What makes this collapse so dangerous is how invisible it is. There's no Lehman Brothers moment. No single company imploding on global television. Instead, it's death by 1,000 cuts, each one a shuttered workshop, a silent loading dock, a broken supply chain node. The factories that once powered the world's cheapest goods are dying behind closed gates, one after another. But the cost isn't just corporate. It's deeply human. Every time a factory closes, someone loses more than just a job. They lose identity, stability, purpose. In China's coastal cities, many migrant workers live paycheck to paycheck. With layoffs spreading and reemployment rates plunging, these workers face impossible choices: return to rural hometowns with no jobs, or stay in cities they can no longer afford. According to a survey by the Ministry of Human Resources and Social Security, youth unemployment in Tier 1 cities exceeded 22% in Q2, with real rates likely higher due to reporting manipulation. Among factory workers aged 30 to 45, underemployment is rampant. Part-time gigs, delivery, food service, day labor are now survival plans for millions. Meanwhile, Beijing insists the economy is on track. State media continues to broadcast upbeat slogans: stable fundamentals, resilient growth, confidence in recovery. But inside the export zones, the message isn't buying groceries. Factories are closing. Freight companies are consolidating. International clients are leaving. Workers are disappearing. And the signs are no longer hidden. They're painted on corrugated steel gates, printed on warehouse notices, whispered between exhausted employees lining up at job fairs that no one attends. China's economic miracle was powered by containers. Those containers are now full but not moving. And that stillness is echoing across an entire industrial class that once defined modern globalization. What happens when the world's factory closes and no one opens another? In early 2025, a U.S. supply chain manager made a quiet but telling observation. When China sneezes, Vietnam catches a cold. But now China's gone silent, and no one knows what happens next. That silence is echoing across the global economy. For decades, China was the gravitational center of global manufacturing. From toys to turbines, fashion to fiber optics, its ports pumped trillions of dollars worth of goods into every corner of the planet. Now, with those arteries blocked by tariffs, shipping collapses, and broken domestic logistics, the rest of the world is scrambling. And the chaos is already here. According to Zenita shipping data, Vietnam's outbound freight to the U.S. surged 43% in early April 2025. Ports in Haiphong and Ho Chi Minh are running at near full capacity. Warehousing prices in India's Chennai port zone jumped 62% year over year. Mexico's industrial parks near the U.S. border are booked out until 2026. Everyone's trying to be the next China, but no one's ready. Supply chain consultants call it the Great Reshuffle. Behind the scenes, U.S. firms are redirecting purchase orders, splitting contracts across Southeast Asia, and investing in nearshoring to reduce exposure. But it's not as simple as flipping a switch. China wasn't just cheap, it was deep. Decades of scale, infrastructure, and specialization can't be replicated overnight. For every Apple shifting iPhone production to India, there's a dozen small to mid-sized brands discovering their new Vietnamese supplier doesn't meet US compliance, or that raw materials still come from China, or that customs delays in third countries erase the savings from lower labor costs. In short, decoupling is painful, and no one gets away clean. The World Trade Organization forecasts that global container throughput will contract by 1% in 2025, marking the third time in 2 decades that global trade volume has shrunk. Analysts from HSBC and Barclays warn that entire supply chain nodes could seize up as fragmented sourcing leads to delays, inflation, and inventory pileups. Ironically, China's collapse is also hurting countries that hope to benefit from its decline. In Ethiopia, textile factories built with Chinese investment are cutting shifts because the orders they expected from Guangzhou never came. In Malaysia, Chinese-owned solar panel plants are slashing output because their goods, rerouted through ASEAN, are now facing US tariffs as high as 3,521%. Even European firms aren't immune. Germany, which relies on Chinese machinery and intermediate parts, has reported delays in automotive and industrial supply chains. And yet, it's the same Europe now preparing to impose anti-dumping tariffs of 20 to 30% on Chinese goods, citing unfair pricing. The message is clear: the world is turning away from China. But the transition is brutal, and the replacement, if it even exists, is years away. Financial markets are taking note. Shipping stocks are in decline. Global logistics firms have slashed earnings forecasts. Commodities traders are repricing everything from copper to rubber. Investors are rotating into defensive assets, gold, US treasuries, Swiss francs. And consumer prices are rising. With cross-border efficiency breaking down, companies are reintroducing buffers. Extra inventory, longer lead times, parallel suppliers. That means higher costs and ultimately higher prices. For American families, it starts subtly. A $29.99 item now costs $34. For European importers, it's container fees rising from $1,800 to $3,200. Death by 1,000 margins. Some call this supply chain nationalism. Others call it economic rearmament. Either way, it's a systemic shift. And it's not just about economics. It's about geopolitics. Washington isn't hiding its intentions. With allies from Japan to the Netherlands, the US is building a chip alliance to exclude China from next-gen semiconductor production. It's offering billions in reshoring incentives through the CHIPS Act and the Inflation Reduction Act. Biden's administration has even floated a supply chain NATO concept, where friendly nations coordinate manufacturing and raw material access, bypassing hostile regimes. The subtext is clear: China is no longer trusted, and Beijing knows it. In response, China's Ministry of Commerce recently launched a campaign to support high-quality cross-border trade. But behind the slogans, insiders admit the policy tools are weak. The private sector is retreating. Even state-owned logistics firms are downsizing their overseas hubs. Meanwhile, Western countries are quietly preparing for the long term. They're not just leaving China. They're building a world without it. The US tariffs were never just about numbers. They were a pressure test, and China failed. Now, the global economy is absorbing the fallout, slowly, painfully, and irreversibly. And in the middle of it all, the ports are quiet. Not just in China, but everywhere that once relied on China's speed, scale, and certainty. A global system has lost its center. The periphery is trembling, and no one, not even those cheering the decoupling, can fully predict what comes next. The containers are still there, stacked 5 high in the rain, lined up at Shanghai port, rusting, waiting, silent. Official headlines speak of recovery, resilience, reform. But on the ground, nothing moves. China didn't lose a war. It lost a customer. Not because America attacked, but because America stopped ordering. Factories built for the world now stand empty. Workers wait for calls that won't come. Ports, once symbols of triumph, have become monuments to overreach. The real collapse isn't loud. It doesn't scream. It hums quietly in abandoned warehouses and canceled freight schedules. So we ask, if this is what silence looks like, what comes next? And more importantly, who's ready for it?